A very good evening, everyone, and a happy Mid-Autumn Festival to everyone. Welcome back to our Driven to Learn webinar series by CGS-CIMB Securities. I am Magdalene, and I will be your host for tonight. This session on China's tech stock sell-off, capitalizing on short-term volatility, is brought to you by CGS-CIMB Securities in collaboration with Societe Generale and ProsperUs. Today, we have two very special guests, Marcus Ng from Societe Generale and Tim Phillips from ProsperUs. Before we proceed further, here is a disclaimer from CGS-CIMB Securities that the information provided serves as an education purpose only. Attendees should do their own due diligence before committing to any financial products and consult your financial advisor before making any decisions. For those of you who have not registered yet, this is our Driven campaign. Do scan the QR code below to show that you've registered, and you might just drive away with a Tesla Model 3 at the end of the campaign. Here's a video of our Driven campaign where you stand a chance to win a Tesla Model 3 as well as 36 Apple prizes when you trade with us.
You're driven enough to succeed? Win a brand new Tesla Model 3 in just 3 easy steps. Open a CGS-CIMB trading account and start trading your way to awesome prices. Participants can trade any of our 6 products to earn tickets. The more you trade, the better your chances. Earn as many tickets as possible from July to December to win the latest and greatest from Apple and be eligible for our grand prize, a Tesla Model 3. What's more, we've also lined up a series of webinars throughout the campaign period to help you become a savvier investor. Don't miss out on these free sessions. Register and level up your trading play. Open a CGS-CIMB account and start trading today. Think you're driven enough to succeed?
So for those of you who have not registered yet, please scan the QR code shown on your screen to register. Back to our session tonight on China's tech stock sell-off, capitalizing on short-term volatility. We have two speakers of the night. First of all, we have Marcus Ng, the Vice President of Cross-Asset Listed Distribution, Asia Pacific at Societe Generale. He is responsible for the product management, sales and marketing of the daily leverage certificates in Singapore and warrants and callable bull and bear contracts in Hong Kong. We also have Tim Phillips, who is currently the head of content in ProsperUs. With over 10 years of experience in the financial industry, he hopes to get the new generation of investors excited about building long-term and sustainable wealth by investing in the global stock market. For tonight's session, Tim will be sharing on his views on the recent China tech industry and how it may pan out over the short to longer term, as well as touch on some key sectors that may be impacted by the current China regulatory clampdown. On the other hand, Marcus will walk us through some of the recent trends of China's big tech stock and how investors can use daily leverage certificates, also known as DLCs, to capture opportunities amidst this volatility. Without further ado, I'll pass the time over to Tim.
Thanks, Magdalene. Can I just take over screen here? Thanks for joining us tonight. So I'm just going to cover a bit of the more macro sort of top-down view about China tech and what's happened in the sell-off. But before that, I think I want to do the disclaimer. This is all my own opinion and is not meant to be construed as personalized financial advice. I think compliance wants me to get that in there, so I'll just put that in there before I proceed. I want to kind of cover a bit about ProsperUs itself, actually. So we're actually a new digital investing service, built a bit more about building, long-term wealth from your first dollar to your last dollar is kind of the founder's ethos. So we kind of want to be on that journey with you over the long term to invest. But obviously, we also have other tools if you do want to trade as well. So we have a build and a boost application, which allows you to either, if you're building a long-term portfolio, to understand what types of investments you want to get into. And then the boost allows you to obviously trade like CFDs, options, futures at competitive rates. And the best thing about it is it's also multi-market. So we're present across about 16, 17 exchanges. And yeah, check us out. We're on the App Store, and we're also actually on prosperus.asia, where a lot of the content that I'm writing along with the team is posted up there. So yeah, stay connected with us on our social media and via our Prosperus website as well, which is prosperus.asia, and check us out and check out the content that is up there as well. Okay, so I'm gonna head into what happened. Okay, so the headlines don't look pretty, as you are well aware. It's been a pretty ugly sort of, I'd say about 3-4 months in terms of share prices. But I think what we can understand from the current sell-off is that it took place, or it has its roots back in last November, right? With the Ant IPO, which got shelved. And I think that was the real turning point for seeing how the Chinese government is starting to clamp down on these big tech names and understand where their thinking is in regards to where they want the country to go. So I think we tend to focus a bit too much on the granular level of the stock and whatever is happening maybe to Tencent or Meituan or Didi. But I think this is part of a broader campaign that the Chinese Communist Party wants to wage for society, for Chinese society. Okay, so this is actually an article that our chief investment strategist Se-Boon Lim wrote, actually following the Didi debacle in early July. And I think his takeaway is quite similar to I think what a lot of more optimistic people are on the Chinese market, is that I think the platform tech names, the giants, they're obviously under pressure, right? Because they've built these walled gardens that are not really open to fair competition. They've blocked each other off for however many years, and they've built these platforms that really only serve their interests or serve their client base. And that's not an open platform, and that's not competitive. That's not fair. So what you're seeing is you're going to see further down the line, according to Se-Boon, I think this is a really salient point, is you're going to see a real distinction between soft tech, which is these internet service platforms, and hard tech, which is what they want to focus on, right? The Chinese government wants to focus on building out their capabilities in semiconductor research and development. They want to start building out their capabilities in healthcare R&D as well. And they want to definitely also really pump up that clean energy capability as well, just because they want to lessen that reliance on foreign oil and foreign energy. So it's not really all about altruism from the Chinese government in terms of doing good for the planet. I think there's definitely a geopolitical angle to what they want to do there in terms of clean energy. And with Se-Boon talking about the underperformance of Hong Kong and ADRs, Hong Kong listed shares and ADRs, versus China A shares, because if you look at the China A shares market following that sell-off in Didi and other sort of internet platform names, the A shares market actually held up pretty well in the following sort of week and 10 days after that, because a lot of the names in the Chinese A shares market, it's very SOE heavy, a lot of state-owned enterprises, as well as those hard tech names like semiconductor, SMIC, a lot of the clean energy tech, clean tech names as well, also listed in the Chinese A shares market. Another takeaway is I think it's positive. He thinks it's positive for competition. And, where do we go from here? You have to be aligned with policy, the Chinese policy priorities. I also wrote a piece, and this is my take. I mean, that was Se-Boon's thinking about where the Chinese government is thinking short term, I'd say. I think this is more of a broader picture on the crackdown on the education sector, which you can also check out. And so this is more to do with where, breaking it down in terms of 3 different distinct areas. One of them is, this was very sector specific on the online education crackdown, which happened, I think, sort of in mid-July, if I'm not mistaken, early to mid-July. And so that's an area where if you're looking at buying those companies, I mean, they are uninvestable effectively, right? But if you're talking about buying China, you've seen a lot of commentators come out and say, oh, China's uninvestable. I definitely don't agree with that. You just have to understand what the risks are going forward and where you can see the opportunities longer term. So I think one of the key points that I've understood from just following China for years, and the government and the economy and obviously the geopolitics involved, is that with the walled gardens in China, where you have the ecosystems of Tencent and Tenpay and And then you've got Alibaba and Taobao and Alipay, and they don't allow each other's services to be used on, on their platforms. That's created walled gardens, right? And walled gardens in tech is negative because that doesn't allow you to, provide services that everybody can use, and then it just hikes up. It allows, these companies to basically hike prices or have punitive sort of ultimatums for younger companies, like sort of upstarts that are trying to make it big. If they want to be on Tencent, they have to be with Tencent. They can't be with Alibaba. They can't be on Taobao. They can't use Alipay. So you have these ultimatums that are being given to companies. And I think one of the reasons Zoom, which we're using today, is so popular is that it completely takes down those walls. So if you think about why isn't, Teams destroyed Zoom by now? Because Teams technically does exactly the same thing, and it should just have destroyed Zoom, right? But Zoom, you can access any call you want through any device with one link, right? You don't need to sign up. You don't need to be part of something. You don't need to be a member. And that's so different to what Google, Microsoft, Apple, these guys have all built in terms of US tech. And so it's very similar with China Tech. They built these walled gardens, and that's negative for competition. That's negative for, small business, SMEs. So I think coming down, you're going to see this be positive overall long-term for competition. I mean, there was one stat which I found quite insightful from end of 2018. About 50% of domestic VC money, investment in China came from either Tencent or Alibaba, right? And so the equivalent in the US at the end of 2018 was 5% from the FANGs. So the FANGs don't have the influence on the startup environment, on the economy, on the on the entrepreneurial mindset of the local economy that these guys had. And so those giants had, I think, way too much influence and power on where the economy was going direction-wise, with entrepreneurs, with business. And so that was an opportunity for the government to take action. If we see common prosperity, that again is going to be something that drives government action, which I think is pretty well known by now. We all know about President Xi Jinping's common prosperity goal and how that fits into an anti-gaming perspective, or an anti-casinos in Macau, which you've recently seen just absolutely crater. That's all quite, I think, it all aligns with where they want to see the country going, right? Less sort of sin, less sort of vices like gambling, less online gaming. And so what you're seeing in that respect is that the government wants the Chinese nation to be a bit more, I guess, healthy in terms of how they think about what they deem as healthy, right? Healthy activity or healthy behavior, and common prosperity plays into that. And I think one key part that we maybe don't look at as much when we're investing is thinking about the 5-year plan and the 14th 5-year plan, which was released last year. I think that's a key that we maybe gloss over, we don't look at enough, because there's a lot of information in those 5-year plans about what the government's thinking, where it wants to go. Dual circulation is one of those key policies, I think, from the 5-year plan in 2020, November 2020. And so what they're looking at in terms of the CCP thinking about economic development and where they want the country to go in terms of the economy, if they think about dual circulation as one part is strengthening their domestic market, which could mean reducing the reliance on foreign oil. For example, China, 70% of their oil is imported, right? So that's a risk for the Chinese government and for the Chinese nation. And where you think about their chips, semiconductors, that's one area in the world where they just really don't have the tech. You've always seen TSMC, Samsung on the bleeding edge of chip technology, right? Chinese chip makers don't have that. So I think that's a real weakness that the Chinese government is trying to fix. And they only consume in terms of their demand or what they actually consume, they can only meet 30% of their demand. So actually 70% of the chips they consume, or the country consumes, is from outside, is imported, right? So that to them is also another weakness that needs to be fixed. So they're going to see a lot more government intervention, or government focus on those areas to help improve the domestic market and the domestic strength of the country. And then if you look at the other side, the flip side of the other dual circulation, is the external market, right? How do they view the external world? How do they want to open up to the world? And so what you're going to see is they view opening up as maybe as a bargaining chip as well, because they want to open up and they want to stay connected with the world, but it's going to come in the form of allowing foreign businesses into sectors that are obviously very, very attractive. For example, wealth management, asset management, the huge amount of savings that Chinese citizens have to invest. You're looking at trillions of dollars, right? So in terms of that money coming in, they've allowed foreign asset managers to now set up in China to do business, to open offices, et cetera, et cetera. But I think that also gives them leverage. It allows the Chinese government to have leverage over Western governments, over Western companies, if they decide that they're not meeting their end of the bargain, or they don't like what they're doing. So you've seen that previously with China when they've kind of shut down Korean department stores because there was the whole fad, the fiasco, with the anti-missile defense system in Korea. And then you had that with Japan also in 2012 with the Senkaku Islands, or the Diaoyu Islands rather, as in terms of they stopped production, or they stopped selling certain cars, or there was riots against Japanese factories in China. So there is the leverage that China has that they can impose because they're so big and the market is so huge. So they definitely want to have that strengthening of the domestic market and control over the interaction for the external market. And so that is going to really drive, I think, policy over the next 5 years. In terms of the takeaways for investors, like where do we want to be in this type of environment where they're very much, very focused on intervention, very focused on where they want to see the country going. I think one of the areas that isn't really talked about much is the B2B space, right? So if you think about the B2C space, if you think about Tencent, Baba, Meituan, they're all very consumer facing. And you're seeing this in the US now with Facebook and Google and Amazon. There are lawsuits against them. It takes years to go through the courts, but the common thread between the US ecosystem and the Chinese ecosystem is all these companies that are facing government action are consumer facing, right? If you think about the big five in the US, you think Facebook, Google, Amazon, Apple, right? And then where's the big one that's left out of that massive crackdown, or that massive, all the lawsuits? It's Microsoft, right? Does it operate in a really B2C space where they dominate a market? They operate in enterprise, right? They operate in enterprise software, and they operate in cloud, and they have a gaming business, but that is also part of with Sony, and so it's not really that defining in terms of its impact on consumers. So you're definitely seeing in China that they want to protect the consumer. They want to protect the average person on the street, the average man on the street, whether that's a Meituan delivery driver who doesn't have health insurance, whether that's trying to get people to get affordable housing, with the residential crash you're seeing with Evergreen. They're all indicative of areas where the Chinese government wants to help the average consumer, the average person. So if you're thinking about where is there a lack of, companies that are coming through, I think in the B2B space, in the enterprise space, in the cloud space in China, you're going to see that ecosystem maybe open up a bit more because there's going to be more competition. And with the shrinking workforce that China has, it has a demographic challenge, right? It's similar to Japan in maybe 20, 30 years ago, where their workforce is going to be shrinking dramatically given the one-child policy. I mean, they can open it up 2, 3, 4, 5. They can let them have as many kids as they want now in China, but that doesn't matter. That's not going to change the mindset of people. So I think it's going to be really difficult for the Chinese government and the Chinese nation to figure out how to get the birth rate or the replacement rate up to 2.1, right? Because at the moment, the replacement rate, the birth rate rather in China is 1.4. So it's very, very low. So they need to get that up. And so one of the ways is they either get up the birth rate, which seems really, really unlikely, or they improve productivity, right? And one of the best ways to improve productivity is to look either at automation or at software, the cloud. So I think the cloud is going to help drive that. I think you've seen that in the US with the ecosystem of cloud players that are listed there and helping drive productivity. In China, that's, I think, going to play out over the next 10, 15 years because it will have to. They'll have to get more productive. They'll have to improve productivity per worker in terms of GDP growth. So that's something to look out for. I think the massive underperformance has continued. That's no surprise. We've kind of seen the lows in ADRs. Whether they are going to be listed in sort of 5 years' time in the US is anyone's guess, because the SEC is coming out and saying that it wants to audit the books in China, and the Chinese government considers that a state secret. So I think there's definitely an impasse there. Whether it gets resolved is really up anyone's guess at this point in time. But I think the best places to be right now, either in Hong Kong or in mainland Chinese markets, because I think ADRs have that overhang, and I think it will stay for a while. In terms of Alibaba, Tencent, there's, I get a lot of questions from clients about this, about whether they're still worth buying and it's on the dip. I'm actually relatively, I'll be honest, bearish longer term over the big giants, just because they're so big already. If you're thinking about where you want to find growth that isn't constrained, I think it's going to be in areas that are a bit more aligned with government policy, as well as obviously great companies. I mean, one area that's done really well recently has been sports, right? I mean, the sportswear companies like Li Ning and Anta Sports have done phenomenal because the government wants Chinese citizens to be doing more exercise. They want them to be healthier. China has one of the highest rates of diabetes in the world. So exercise is one of those things that is going to help people live longer, healthier lives and be happier. So that's an area where they've really sort of focused on, and you've seen that with the share price appreciation of those kinds of companies. In terms of Alibaba, there's talk about the cloud driving the growth, and it's huge. And there is definitely growth in the cloud, but we have to remember that commerce, still makes up the e-commerce core operations still make up about 90% of their revenue, right? So it's still driven by e-commerce. And in a market where in 2020, they had about 53% of the e-commerce market in terms of sales, I think for them, the only way that's going to go is down, is south, right? So if you think about JD, if you think about PDD, those guys are doing some really, really interesting things, either in grocery or in, farmers producing goods and then delivering to market fresh produce, which is, I think in the PDD's like wheelhouse. They're really thinking about how to help farmers in tier 2, tier 3 get produce to market. And it's, I think they're building that infrastructure out. Whether Alibaba is going to be involved in that explosive growth is less uncertain, I think. So I'm not a huge fan of it longer term. And then finally, the slowdown isn't helping in China, right? We're kind of seeing that with property. I think this is going to be the straw that broke the camel's back, so to speak, with Evergreen. I don't think it's going to lead to some sort of Lehman moment or crisis, but obviously I think they will default. About 200 billion out of the 300 billion in liabilities from Evergreen was actually cash paid down by depositors for apartments, which were never built. So that's a problem. You're seeing that with housing prices starting to come down as well, right? So on the right-hand side, on the left, I think it was a tacit admission by the PBOC that they've cut the RRR recently. They had only cut it once during the whole pandemic, I think in April of 2020, and then they cut it again about 2 months ago. So it's an example, it's a sign, I'd say, rather, that the economy is slowing. How much of an impact that's going to have on growth is again up for debate, because everyone's been saying that it's been a bubble for 10 years, but it's never impacted the Chinese economy enough or had that blow up on them, right? So they have very high deposit ratios. There's a lot of equity in the housing market for most Chinese consumers, most people who own property. So I don't think it's at a level of systemic risk like in 2008-9, where in the US, but the economy is definitely slowing. And I think the Delta variant is just going to aggravate that and exacerbate that. So yeah, that's it from me. I have upcoming sessions, so check us out. We have one on the 7th of October for Hong Kong stock market. I'm from Hong Kong, and I've grown up with Hong Kong opportunities, seen the market evolve there. It's really, really interesting. There's so many more opportunities in stocks and great companies rather than just Tencent, Alibaba, Meituan, and join in and hear about it from myself and Samuel, a market specialist from the China Solutions team at CGS-CIMB. And then we're also going to be doing ESG. Everyone loves ESG, but what is it, right? And do you want to be owners of businesses that are not really taking it seriously? So I think these are questions that a lot of investors, both retail and institutional, are asking themselves now. So join us for that one on the 28th of October, both at 8 p.m. So the 7th for the Chinese stock market, the Hong Kong stock market, and then the 28th for the ESG. That's it. I'm going to pass my mine off to to Marcus now and yeah, get into the nitty gritty.
Thanks, Tim, for the insightful presentation on the China tech scene. Now we will pass the time over to Marcus.
Okay, hi everyone. Hi, my name is Marcus. Thanks, Magdalene, and thanks, Tim, for the introduction as well. Great stuff from Tim. So he has given a bit of the fundamental picture, right? The longer term picture. So for myself, I want to dive a bit into a bit more of a shorter term time frame, and also to look at some of the underlyings of this product called daily leverage certificates. So just a very quick introduction first. My name is Marcus. I am from Societe Generale. We are the product issuer of this exciting product called daily leverage certificates. So we do have it listed on Singapore Exchange. So it is tradable via your a regular stock brokerage account, including CGS-CIMB as well, on their trading platform. You are able to access the daily leverage certificates as it is traded on SGX Securities market. Okay, so this is a relatively new product. This was launched 4 years ago in 2017. And over the last 4 years, we've seen very encouraging growth in terms of people using the product for their short-term needs and be able to capitalize on this short-term volatility in the market currently we've been seeing in the last 2 months, especially in the Hong Kong market. Okay, so I'll do a very quick introduction to the product. And I know that you guys have a lot of questions for us, including Tim as well. So I'll keep it within 15 to 20 minutes just to cover the basics of DLCs, to introduce it to you guys, as well as give you a tour a bit of our website, our dlc.societgen.com, for you to see what are the tools available for you to look at. Okay, I'll dive right in. So as I mentioned, we've seen a very encouraging growth in terms of the people adopting the DLCs, using them in their trading needs. So you might have a portfolio of stocks, for example, right? All your fundamental analysis goes into it. You buy and hold to this kind of value stocks or even tech stocks for growth. But within the short-term time frame, within a span of like days and weeks, you might want to look at some of the tactical instruments that you can use to be able to capitalize on the short-term trends in the market or even hedge your long-term portfolio. So definitely 80% of your funds should go into your investment portfolio, but then maybe 10 to 20% of them can be allocated for more tactical moves in the market. Okay, so the DLC's daily leverage certificates have a wide range of underlyings you can choose from both Hong Kong and Singapore. We cover most of the indices, your MSCI Singapore Index, your Hang Seng Index, as well as Hang Seng China Enterprises Index, as well as over 50 stocks that you can choose from. Between the most of the STI constituent stocks are covered under our DLCs, as well as the Hang Seng Index constituents. So all your big tech names are in there as well. We even have the Hang Seng Tech Index as well, where you can do leverage exposure on the Hang Seng Tech Index. So we have all the big names: Tencent, Geely, Alibaba, OCBC, DBS, the banks. So definitely it's a wide range that you can choose from. We have over 225 DLCs listed right now. So we grew from our first launch in 2017 was only 10 DLCs on the index, on the indices, but we have since grown to 225 DLCs for investors to choose from. Okay, so what is a DLC? Just before I rattle on, a DLC is, I mentioned, it's an exchange traded instrument that's listed on SGX Securities market. So you can use it. You can trade it directly using your stock brokerage account. You trade it like a stock. So there's no need to worry about marginings. There's no need to worry about options, etc. This is more of a linear product that investors can use to gain leverage exposure. So the DLCs is a leverage product linked to an underlying asset. So there is a long and a short DLC for every single underlying. So if you are bullish on the underlying stock, you buy the long DLC, to gain that leverage exposure on the upside. But if you are bearish on the underlying stock movement, you'll buy the short DLC. So that way you can profit or you can gain when the underlying stock goes down. So please do not go and short sell any of the DLCs. In SGX securities market, there is the concept of short selling. You can go into buying market, etc. So that is a very dangerous part. So do not go and short sell the long DLC, thinking that you want to go short on the underlying stock. Just to note, you should buy the long DLC if you're bullish, and you should buy the short DLC if you're bearish. Okay, just to be clear on that. And also it's listed, each DLC is a separate trading counter. So that's what I mean by you should buy the long and you should buy the short. You shouldn't go and short the long DLC, for example. Okay, so the DLCs promise a fixed daily leverage. It offers 5 and 7 times leverage Right now, we offer up to 7 times leverage on the indices. So that is your MSCI Singapore Index, your Hang Seng Index, as well as Hang Seng Tech Index. Okay, on the single stock DLCs, you will have the 5 times leverage, both on the upside and the downside, meaning 5 times short DLC and 5 times long DLC. Okay, and on a intraday basis, during the trading day itself, there'll be a liquidity provided by designated market maker, which is the same as us. The Societe Generale, we are the issuer and the designated market maker. We are obligated to be in the market during the trading hours to provide liquidity for investors to buy and sell. Okay, so what does the DLC do? How does it provide that leverage? So it is a pretty efficient instrument for you to use to gain leverage. So every day, the DLC will give you that leverage performance over the underlying stock performance. So for example, if you have a 5 times long DLC, for example, right? You buy the 5 times long DBS DLC, and DBS goes up by 2% today. From yesterday's close, it went up by 2% today, from $25 to $25.50, for example. So you bought the long DLC yesterday, and today you will see that leverage gain in terms of the 2% gain in DBS times 5 is 10%. So you will see that 10% gain in the 5 times long DBS DLC. And then you will see, correspondingly, you will also see that 10% loss in the 5 times short DBS DLC. So that's how the DLCs provide that leverage exposure in terms of the percentage gain every day on the underlying stock. If the stock is up by 1%, then my 5 times DLC is up by 5%, for example. Right? If it's up by 2%, then my DLC is up by 10% in multiples of 5. Okay, that is where your leverage factor is achieved, and that's where we provide the leverage that leverage exposure for you to the underlying stock. Okay, so you can see that on our website later. I'll just show it a bit later. You can see that 5 times performance from the between the underlying stock. In this case here, DBS is up by 0.54%. And over here, the DBS long DLC is up by slightly more than 5%, more than 5 times the performance. So it's up at 3% over here. Okay. So what do you use DLCs for? I mentioned this is a short-term trading instrument, which we have provided for investors to be able to gain that efficient tool for them to be able to gain that exposure. So they use it for day trading. What we see in the market is there are quite a lot of intraday traders around. With all the new batch of traders that came in, last year during the COVID crisis, as well as the beginning of this year, we saw a huge sort of uptick in terms of day trading as well. So this instrument is efficient for you in terms of day trading, not only because it provides you with that leverage, but in terms of the cost efficiency wise, it is a very efficient tool for you to be able to minimize your costs while maximizing your potential return on your trades. Okay, on the swing trading side, it also can give you a bit more of a longer term trade. So swing trading could possibly be about 5 days to about maybe 2 weeks, 3 weeks. So the DLC do offer you the exposure also for swing trading. And lastly, also for hedging. Like I mentioned just now, if you have a portfolio of, you have 10-cent stock, a huge sum of 10-cent stock that is you're gonna hold until you retire. So you don't want to touch that at all, but you see 10-cent correcting. That's where your DLCs come into place. You might want to buy some of the 5 times short 10-cent DLCs to be able to hedge your position in terms of a short-term market correction or in terms of a short-term correction in the 10-cent stock, just to hedge your portfolio a bit. Okay, so these are some of the benefits, some of the users for DLCs. In terms of day trading, you can see here the Meituan rose from 2.6% within the day itself, between 9:30 a.m. to 4 p.m. That's when Hong Kong market closed. It rose by 2.6%, and the 5 times long Meituan DLC DZHW rose by 14.5%. Okay, swing trading again, also UOB was up 9% from 25th Feb to 30th April. So swing trading maybe a bit more. You might want to use it for maybe Singapore stocks, which doesn't move 5% or 10% in the day. Singapore stocks tend to move a bit by a bit, but once they get the right direction right, it tends to go in a bit of a more of a trend for some of the Singapore blue chip stocks. So for UOB, it was up by 9% from 25th Feb to 30th April. The DDWW, which is a stock code for the DLC, the 5 times long UOB DLC was up by 48% during the same period. So this is a span of maybe about 2 weeks. It's about 1 month. And then that's where you can get also the swing trades done on the DLC. And lastly, on hedging, that one is more it's the same as in the sense that if 10-cent is down by 24%, this DMIW, which is the 5 times short 10-cent DLC, was up by 209% during that 1 month where 10-cent corrected quite heavily in July. but then the short DLC help to cover some of the losses. So hedging is one of the users as well for the DLCs. So I mentioned that that this DLCs is quite a cost efficient instrument, right? So all the DLCs are priced between 20 cents to about $2 range. So that is the price of the DLC compared to your 10-cent stock, for example, right? So a minimum lot size for a 10-cent stock is quite high, and then the minimum investment sum for 10 cents, you need about, last I saw is about 8,000 Sing to 10,000 Sing for you to be able to gain exposure to 10-cent stock itself, to buy one lot of 10-cent shares on Hong Kong market. Whereas for the DLCs itself, right, the 10-cent DLCs, it's only priced between 20 cents to $2, and then you can buy it in lots of 100, which means that you can strategize a bit. You can buy a smaller exposure and start to scale in if you want, as opposed to putting one lump sum of $8,000 or $10,000 to buy the 10-cent stock on Hong Kong exchange market. And of course, trading it in the local market on SGX Securities market gives you the benefit of local regulatory environment. You're familiar with the SGX market, as well as it's denominated in SGD, so you have your whole big portfolio of US stocks, I believe, definitely, where you are already exposed to the US currency. And then the Hong Kong, if you want to change your Singapore dollars to Hong Kong dollars to go and trade the 10-cent stock or Alibaba or Meituan, you are again being exposed to the US currency exposure, right? Because the Hong Kong dollar is pegged to the US. But then to be able to use the Sing dollars to be able to get exposure to 10-cent, that's one benefit that the DLCs are able to provide in this case. And also the cost of trading on Hong Kong Stock Exchange itself is quite expensive, given that they also recently increased the stamp duty. So when you trade the DLC on SGX Securities market, you are paying a very much cheaper in terms of exchange fees. The DLC exchange fees is 8 times cheaper than your stocks on the DBS or UOB. So I think the exchange fees for the stocks is about 4 bips, whereas for the exchange fees for the DLCs, it's only at 0.5 bips. So it is a very cost-efficient instrument. I'll just go a step further to also just share a bit about the comparison with another sort of similar leverage product, but it is on the OTC world. So I guess some people might use CFDs, which is a very good product in that sense for the CFDs, contract for differences. It's a very good leverage product that people use in the OTC market, but I think there is some people prefer that. Some people prefer a more exchange listed product, and also for the DLCs, one of the pros and cons between the two is towards DLCs, it's a lot more cheaper in terms of commissions that you pay, right? For the CFDs, if you buy, say, $10,000 worth of exposure on DBS CFDs, you are paying commissions on that $10,000 worth of commissions, even though you put $2,000 in as a margin. Whereas for the DBS DLC, if you buy a 5 times long DBS DLC, you do have that, you put in that $2,000 to gain that $10,000 exposure to DBS stock, but you only pay the commissions that 0.1 or 0.2% on that $2,000. So it is a very cost-efficient instrument if you are a very active trader on the on the DLCs, because you can save a lot in terms of exchange fees, commissions, currency risks. So it is a very cost-efficient instrument for you to be able to actively and also gain exposure to the underlying stock or index in the short term. Okay, so but one of the cons, I guess, just to be fair here, one of the cons of the DLCs is, compared to the CFDs, is that it has a very unique feature in terms of the compounding effect, right? So this compounding effect is unique to the DLCs, which is not on the CFDs, which is what I'm going to touch on next. I would like to go on to compounding effect. So compounding effect, it works for you or against you in that sense. Okay, so you either, it can work for you or it can work against you. So for the compounding effect, these DLCs are reset on a daily basis. Every day you get that 5 times performance. If today the underlying stock is up by 1%, I get that 5% movement. Next day, I get the underlying stock is up by another 1%. I get that 5% movement again, but based on yesterday's close, which already factored in yesterday's gains and losses, right? So every day the gains and losses are locked in, and it's best illustrated using an example here. So in a sense, if the underlying stock is up by 1%, 2%, and 2% consecutively over the 3-day period, the 5 times DLCs are by 5%, 10%, and 10%, right? And so at the end, the underlying stock is up by 5%, right? But the 5 times DLC is more than 5 times the performance of the 5%, right? 5 times of 5% is 25%, but the DBS DLC, I mean the DLC itself is up by 27%. So that's where compositive compounding comes in. So this is good for investors in the sense that you get more than that 5 times return in a strong trending market. But in a sideways market or a very volatile market, you can see over here that it might not work so well for the investors, because at the end of the 3 days, you can see here that the underlying is up by 5%, but the 5 times DLC is up by 20% only, not 25% as some people might think about the 5 times performance. So that's where the compounding might not work for you in a very volatile or in a sideways kind of trending market. So I would say that the DLCs perform their best in a strong trending market, whether is it an uptrend or is it a downtrend. The DLCs do work for you in terms of the compounding effect. But in a sideways market, it does not. It's not very favorable for investors. That's for the compounding effect. Okay, so these are some examples of the compounding effect. But I would like to jump straight just to showcase a bit of the our website, so they can see what are the tools. So I'll take about 5 more minutes just to show you guys the website. Let me just stop this share first. Okay, so this is our website. So it's at dlc.sociegen.com. So you can come here on this website to have a look at the DLCs. We do showcase a lot of information about the DLCs as well as the underlying stocks. So you can go to our search bar to have a look. You can look at the underlying itself, look for an underlying, and then you can search for it, Hang Seng Index, and then you can see there are a few DLCs that you can choose from. The ones with the star are the most sensitive ones. So for those who are intraday traders or very short-term traders, we will recommend to you get this DLCs instead of the others. Okay, so I know we mentioned some of the underlyings just now. We have on the Hang Seng Tech Index itself over here, and you can see Hang Seng Tech Index itself. You can look at the compounding return on it itself. So you can see our historical compounding return tool over here, where you can see what is the historical compounding over the last 7 trading days, or you can extend it to see how long it is in that time frame itself. Okay, so you can see maybe over the past 10 days, for example, right? You look at the 5 times short. I think it was quite bearish, the Hang Seng Tech Index, over the last few days. So I look at the historical compounding return. I look at the last 7 trading days. Okay, it was down. Hang Seng Tech is down by minus 5.34%, right? So, and then correspondingly, the 5 times short Hang Seng Tech DLC gives you that 25% return over there. Okay, so you can drag it and see what are the different returns over there. Just to do a time check, Madeline, am I good on timing, or do we have a bit more time just to look at a few more underlyings?
Yes, we're good on time.
Okay, great. So just to have a look at a few more underlyings over here, you can see Hang Seng Tech, but we have a few others. So Tencent DLCs, so many to choose from, so hard to choose. So we put some stars over there to show you which are the most sensitive DLCs to choose from. So Tencent stock itself, you can see over here today, and also here. Okay, so over here, you can see that the Tencent short DLC is up by 0.9%, down by 0.9% today, and the Tencent short DLC is up by 4.1% over here. Okay, actually it should be 2.45. This was probably the last traded price, but this is the final price itself. Okay, then you can look at the historical compounding return. There is the price matrix that people can look at as well to see intraday, during the day. My Tencent is priced at $2, right? But then what about the Tencent stock is actually moved, is actually a different price level. How do they move together, in line? If Tencent goes up by, how many points, how would my DLC move? So that's what the price matrix is for you able to see that, okay, if the Tencent stock rises from 450 points to 466, so that's up by 3.56%. My 5 times short Tencent DLC will actually be down by 17% or 18%, down to a $2 level. So the price matrix is a good reference for people to see, intraday, what are different price levels which corresponds to between the underlying level as well as the DLC level. Okay, so over here we also have Alibaba, quite a wide range for you to choose from. Alibaba long and short. Let's look at Alibaba, at 11.3 cents. Okay, so over here, the Baba is down by 1.85% today, right? And then the 5 times long Alibaba is down by minus 8.6%. The 5 times short Alibaba DAGW stock code is up by 8.9% over here, right? So this way you can see the 5 times movement over here. Okay, you can have a lot of information over here. And then there is the simulator, the price matrix, the chart, which we recently enhanced as well. Over here, you can see the chart. Okay, not this one, sorry. Go to here. This is the interactive chart for investors to look at. You can look at the Alibaba, you can draw some lines. You can see how has it performed. So it has been quite a range recently. It looked like it broke down from the range, I don't know. But then this has been on quite a downtrend. We can look at the different Alibaba stocks available as well. Alibaba is on a downtrend. Let's look at the historical compounding return, see whether how has it performed. Tencent, so Alibaba is down by minus 7.52% over the last 7 days. The 5 times short Alibaba DLC DAGW is up by 42.03%. So this is an example of positive compounding effect. It's more than 5 times the performance of the underlying stock itself. Okay, so I won't go on too much anymore about this, but there are quite a lot of tools available for investors to use to get the price matrix, historical compounding return, and a lot of charts on the underlying stock for you to look at. We have our education information over here for you to look at as well. Quite a lot of information here for you to look at. And most importantly of all, also wanted to just share that we have an ongoing simulation tournament right now that is ongoing together with Investing Note. So this is a tournament for investors to use virtual money to be able to play around with the DLCs, learn about it as you trade it, before you move on to real life trading. And then there are $10,000 worth of prizes for you to win as well. So this one is from 13th September to 22nd October. So it's not too late for you to sign up and try it out, and hopefully in the process also win some prizes. And the most important thing about the website, of course, is this thing over here, our DLC hotline. So you can reach us at this number. If you need any help, any questions at all, please just do this number, and my team and I will be able to help you with any of the queries that you have on the DLCs. So I'd like to stop here already. I think I've taken enough time. Yep. So I hope you will look at the DLCs and also check out our website.
Okay, thank you, Marcus. I think we've learned a thing or two about DLCs. I think you can stop sharing screen.
Okay. Yep.
Okay, now we have reached our Q&A sessions. So I think we've received quite a few questions tonight. Let me go through it one by one. Okay, the first one, will there ever be an end to the China negative sentiments with the recent Evergreen crisis happening right now? I think, Tim, do you want to answer this?
Yeah, so I mean, in terms of negative sentiment towards China, I think that it will probably continue for a little bit if there is, further regulatory action, I think. But as to how long that will continue is anyone's guess. I mean, everyone always talks about the bottom being when there is clarity for, the big tech giants as to whether they can continue on, and, there's visibility on regulation and all that. But that is, at this point, like a lot of speculation, right? So I think with Evergreen, that's a different case, right? That's actually like a default, and that's something which, if you've been involved in that space or you've been following that space, I think it's been quite well documented that they were in a lot of trouble, and that they were probably going to default anyway. So I don't think it's a shock to the market. Maybe it's a shock to some investors in the US, but I think for most people in Asia, it's been pretty well tracked that they were in trouble. So I think the question was whether the government was going to bail them out or let them go to the wall. It sounds like there will be some hybrid solution to that. I don't think they will let them completely default on everything, but yeah, I think the sentiment is always going to change, right? There's always going to be positive news, and then there's always going to be negative. I'm not particularly bullish on the big tech guys, but I'm definitely bullish on just China and the economy over the next decade. I think there's definitely going to be opportunity. I just I personally just don't think it will be in big tech.
Okay. Second question. How will Tesla be affected in China if other major EV players in China merge together, such as NIO and NIO, as suggested by senior officers in China? Tim?
I think Tesla will be fine. I mean, Elon Musk is trying to be really buddy with, the Chinese Communist officials, and he's trying to suck up there and get obviously as much business as he can for Tesla. I think for a lot of companies, I think with Tesla, it's a unique case because the EV market in China is just so humongous that this American company can't ignore it, right? But if a lot of American tech companies, you're looking at them, do they even want to bother going into China? I mean, for example, a few months ago, there was an interview with the Twilio CEO and founder, Jeff Lawson. And, Twilio is, a platform as a service kind of provider that does a lot of SMS messaging and like email messaging and helps companies with their communications to customers, right? Their market is already huge outside China, and he has no interest in going to China, mainly because there's that geopolitical risk, there's that leverage over them. So the Chinese officials obviously have leverage over Tesla. I think Elon Musk knows that. I think most people know that. And that's one risk. If you're a company CEO, you probably don't want to deal with, unless the opportunity is so good you can't pass it up, which I think, Tesla has a great opportunity. Whether they're gonna benefit from that to the tune of, taking a massive share of the EV market, I don't think they're gonna be the leader, because I don't think the government would want that to happen. But I definitely think that there will be consolidation, just because there's way too many Chinese EV makers. I mean, there are like, I think Evergreen had like an EV maker that was worth about 80 billion at one point, and then now it's crumbled. So I think there is definitely a shakeout that needs to be done in the EV market, but I don't necessarily think Tesla is going to benefit, is going to be seeing outsized benefits from that.
Okay. Next question. This is an interesting one. With China banning online video gaming, how does it actually impact the China tech industry? Marcus, do you want to share your view on this?
I would defer this to Tim. I think he's a better person who to answer this. Definitely.
Okay. I think the question, I think banning, you mean like underage, like.
Yeah, I think that was the reason.
I think there's been a slowdown in game approvals. But I think the SCMP, South China Morning Post in Hong Kong, reported that there was a complete ban, but actually that was that turned out to not be true. It was just a slowdown in approvals. So that's a very different thing. But there is definitely, you saw the whole spiritual opium and that impact on Tencent share price and NetEase's share price, which is a gaming giant as well. I think my concern, if I was a Tencent investor, would be that the future is based on all these young kids gaming, right? I mean, at this point in time, I think Tencent themselves said it made up 2% of their gaming revenue. So it's really insignificant at this point in time for young kids and their gaming revenue contributions to Tencent's top line. It doesn't really make much of a difference. But if you're thinking about what are these kids of today going to be doing in 5 or 10 years, are they going to be gaming as much? Then that would be a worry from a structural perspective. If the government wants them to go out and, I don't know, play sports or do other things or do other activities, and that's not gaming, right? So the government has honed in on gaming as obviously an activity that they don't think is positive for kids or for society at large. I would say with Tencent, they have a very, very big international gaming stable. So they're much better protected than sort of like a NetEase, which is much more focused on domestic China. But obviously Tencent gets a huge amount of their revenue from China, but they do also have a lot of international gaming exposure. So I think they're obviously trying to grow that because they probably know that I think in future there's going to be, there are going to be road bumps. So I think it's going to negatively impact gaming longer term in China, but I don't think you're going to see that play out immediately overnight.
Okay. All right. The next one, Marcus, is for you. Which is more viable in your opinions, to enhance returns via DLCs or to hedge your position via DLCs?
Well, why not both? So I think you can use the DLCs to enhance your returns in the short term, and you can use the DLCs to hedge your portfolio position as well, in the short term. But I think if I were to answer it directly, I think I would say it's better in terms of enhancing the returns via DLCs. Hedging via DLCs, I think you need to just be careful how you play it. In terms of the hedging proportion between how much exposure you are on the DLCs and how much exposure are you on your investment portfolio side itself. You need to get that calculation a bit correct, so that can be a bit tricky for a beginner investor. So do be careful in terms of how you hedge also. But otherwise, I think in the short term, enhancing your returns via DLCs is definitely the way to go. You can use that to capitalize on short-term trends on the underlying asset, whether it's an index or a stock. And then you can also, I think the best thing about it is also really you can trade both sides of the market. You can go either long or you can go short. You don't have to wait for a bull market. You don't have to wait for a really long-term bull market for you to be able to get in the short-term volatility. Like now, you will see opportunities on the underlying sort of stocks and as well as indices every day for you to be able to use the DLCs to enhance your returns.
Okay. To follow up on that, another attendee asked, why should I choose DLCs over CFDs since they are quite similar? CFDs can also long and short positions.
Oh yeah, so I think that one, I've shared a bit about it just now on the CFDs. So I think there are pros and cons to this kind of products. They're both leverage instruments and they're both efficient instruments. But one is on the listed space and one is on the OTC space. So for someone who, are comfortable with margins, comfortable with the OTC space, why not CFDs? But if you have a preference towards a listed space, and also you want the convenience of trading it through your regular stock brokerage account, you don't want to create a new account to be able to get the extra leverage exposure, then you can use DLCs. But there are sort of pros and cons of each and different features. For CFDs, you have to understand margining itself. You need to understand, what happens when there's a margin call, what do I do? These are some of the risks that you have to take note of. When I trade DLCs, you have to understand the compounding effect return, right? You have to understand how it works, that 5 times leverage every day. How does it work? Because, the compounding effect can work for you or against you. So this is a very important feature which you must understand. In terms of fees wise, I think both are quite competitive, but as I mentioned just now, the CFDs, they charge the fees. The commissions are based on the total exposure, total notional exposure, whereas for the DLCs, they charge based on the premium. So there is a slight advantage there in terms of the fees. But then again, I do see a lot of CFD players out there also offering, zero commissions. So that might not matter to some of the CFD players. So you have to look out for it. But I think if you are trading, it's important to find a low-cost trading instrument for you to be able to make your short-term trades. But that shouldn't be the full picture. You have to look at everything else, whether your skill set, whether your psychology of trading. I think the fees is something that could be maybe like a secondary or 4th or 5th consideration when you trade. So that's how I would say it's a balanced approach for DLCs and CFDs, and it's up to investors to choose.
Okay. There is an attendee that's asking if someone wants to start actually trading DLCs, what are your top 3 tips to take note of?
Okay, so I think for DLCs, top 3 tips. Okay.
For a new investor, I guess.
Yeah, I think. So I think number 1, for the biggest tip I would give is to, very importantly, is to make sure that you understand which DLC to buy, right? So that's very important. First of all, is if you are long if you are bullish on the underlying asset, you expect it to go up, please buy the long DLC, okay? And then if you're bearish on the underlying stock, you expect it to drop, then you go and buy the short DLC, okay? So this, and then you don't go and sell the long DLC in that case. So there's 2 different DLCs that you have to be aware of, 1 long DLC and 1 short DLC for you to choose from, depending on the direction of the market. Okay, and second thing, I think the other tip is to understand also what the term of intrinsic close is, right? So that is the close of the DLC at the end of the day market close. Sometimes the last traded price of the DLC on SGX market can be, say, at 2 p.m. or 3 p.m. But between 3 p.m. to 5 p.m., the underlying stock is still moving, right? Your DBS stock is still moving all the way till 5 p.m. So the DLC also moves in line, including our market making offer and bid and offer codes, moves all the way till 5 p.m. But SGX captures the last traded price at 2 p.m. as its closing price. So you need to refer to the intrinsic close value of the DLC every day, which is published every day at the end of the day on our website. And then for the next day, you can see that the 5 times performance is based on this intrinsic close rather than the last traded price, which is at 2 p.m. Right. Okay, so that's the second tip. And the last tip is listen to as many webinars as you can, take as much advice as you can. CGS-CIMB, ProsperUs, you guys have created the most number of webinars I've seen in the 2 month span or 3 month span I've ever seen. But it's great. There's a lot of topics over there. So when you trade the DLCs, when you trade in a foreign market, it is always good to listen to more views and get more advice. So I think that this webinar series will be very helpful for all investors out there.
Okay.
Okay, that's all I have for the 3 tips off the cuff of my hand. Yeah.
There's another question on China tech industry. So Tim, do you think big tech in China, such as JD, Tencent, and Alibaba, will be broken up?
I don't think so, but I don't know. I don't think anyone knows what Xi Jinping and the CCP are thinking. But I would say that that's not necessarily a bad thing all the time. There's talk of breaking up big tech in the US, but actually a lot of investors would, for example, love to have, AWS as a standalone company, Amazon Web Services. So like Amazon's cloud computing division, which is really the cash cow, the cash generator. They would love that to be listed separately, right? So if Tencent maybe lists, I don't know, their fintech arm, or if JD lists. I mean, JD's already started to list a lot of its businesses. So it's listed JD Logistics, it's listed JD Health. They could spin off more things. So I think there's no saying this. It's not like a hard and fast rule that if they are broken up, it's bad for investors. It might be like, the sum of the parts might be better, taken apart rather than as a whole. So, I mean, it depends on your view. If it's a negative regulatory action and you think that these companies don't have standalone businesses worth investing in, but if you like specific parts of these businesses and they end up being broken up and then listed, then that's a totally different thing. But, then again, I think we might take it a bit differently in China. If they're broken up, it might be more of a state intervention-led breakup rather than in the US, where maybe the state requires them to break up, but it's more market-driven where they list. So I don't know what the Chinese government would be thinking about if they did break them up. Maybe listing them separately as like standalone companies wouldn't be top of their priority. So I think it depends on the breakup and where you see opportunities, but I think at this current point, they don't really want to kill the tech giants. They just want to control the data that they have and control, their platforms. So I don't necessarily think they want to break them up. It's just they want them to open up. Yeah, that's probably a good soundbite. They don't want to break them up. They want them to open up, and they want, Tencent and Alibaba to open up their walled gardens to everybody to use.
Yeah, that makes sense.
Yeah.
Okay. I think we have one more time, a bit time for a last question. How will the Evergreen issue affect the DLC market? Marcus?
Okay, so I think I guess the Evergreen sort of news is everywhere. Every single person is writing about it. Every single article. I think every single TV news channel is talking about it as well in terms of contagion risk, right? I mean, across the markets. So I think you will find a lot of information if you just Google Evergreen, crisis. Pretty sure you can get information. But for the DLCs itself, I think we do see quite a bit spike in volatility in the Hong Kong market itself over the last 2 to 3 days, including last Friday as well. It is definitely a spike in volatility for the Hong Kong market. So you see big moves, big swings in the underlying stocks itself, particularly on the I would say suddenly the old economy stocks are also back in the limelight again. your property stocks, your bank stocks. So we do have some of these underlyings as well on the DLCs, and so we are aware of how volatile it can be. I think Sunac is up by 8% or 7% today, but it was down by crazy amount over the last 2 days. So there's a bit of relief there on Sunac, the property counter. We also have SHK, and I think we have one of the more Evergreen counters linked would be HSBC. So a bank stock, but it is also quite exposed to the Evergreen sort of crisis in terms of its exposure. I think it's just behind UBS, so I think it's something that investors can also look to gain exposure to using the DLCs. We have the HSBC DLCs, both long and short side. So I think the crisis is probably a bit great for the DLC market in the sense that there's a bit of volatility. We see a lot of activity also, people buying the dips, longing the dips, or people, shorting into strength. So we do see a lot of people riding on this short-term volatility.
Okay. I think that's all for our Q&A sessions. Thank you, Marcus and team, for taking your time out to speak in this session. For everyone, thank you for joining our session. If you have not followed our socials, please do scan the QR code on the your screen. There's our Facebook, our Instagram, and LinkedIn. And like what Marcus said, join more webinars and you will learn more.
Yeah.
Thanks, everyone.
All right.
Lastly,
thanks,
thanks everyone. Thank you for your time. If just now, if anyone has not scanned the QR code to join the Driven campaign, you can scan the QR code now on your screen. And this is to scan the QR code to just answer a simple survey, post-webinar survey. So once you answer this survey, you might stand a chance to win a $50 Takashimaya vouchers, or for the Malaysian registrants, you can earn a $50 ringgit Grab vouchers. Yeah. Thank you. Thanks, everyone.
Thank you. Bye.
Thank you.
Bye.
Oh my God.